The Turkish lira is on a wild ride. In 1 week, it's dropped more than 30% against the US dollar, and President Recep Tayyip Erdogan says Turkey should be prepared for more economic shocks.
We must be prepared for different forms of attack on Turkey's independence, economic interests, national honor, dignity, and personality. In recent years, the most important reason why we've been exposed to a series of operations involving terrorism and economic manipulation is that we are striving for an uncompromising attitude when it comes to our national interests.
Last week, US President Donald Trump raised tariffs on Turkish steel and aluminum imports, demanding the return of American pastor Andrew Brunson, who's on trial in Turkey. Analysts say it's the worsening relations with Washington that are behind the depreciation in the lira. That's having a knock-on effect on other economies.
Mainland Europe is not a very dynamic growth market for European banks. They've gone looking elsewhere, and to some extent in emerging markets. Turkey has been an avid consumer of loans. Again, I've mentioned that current account deficit. Well, a lot of that's been funded effectively by forex debt, particularly within corporates, and Eurozone banks with extremely low funding costs and few growth opportunities elsewhere are only been too happy to oblige. So yeah, they've been caught with their hands in the cookie jar.
On Friday, shares in European banks fell, and on Monday, investors were selling stocks in US banks that hold a large chunk of Turkey's external debt. The risk of contagion is unnerving European leaders as well.
We profit from it when there's a stable economic environment around us, around the European Union, and everyone needs to contribute to this. Germany would like to see an economically prosperous Turkey. This is also in our interests.
Turkey's finance minister says he plans to cut the budget and current account deficits to rein in the country's foreign debt, and the central bank has taken action to support its currency. It's lowered the proportion of deposits that banks must park with the regulator. That applies to the lira as well as foreign currency deposits. The central bank's also curbing dollar-lira swap deals to discourage speculative bets against the local currency, and it says it will take more steps to ensure banks and other financial institutions have enough cash for their operations. That's helped the local currency recover from a low of 7.4 liras to the US dollar. But the economic fallout from this dispute between the US and Turkey appears far from over. Mobin Nasir, TRT World.
Jameel Ahmad is the head of strategy and markets research at forex broker FXTM. He says investors will keep watching for an interest rate decision by the Turkish central bank.
What investors really want to see, and they've wanted this for some significant time now, is a serious increase in Turkey interest rates in order to prevent the lira from falling any further than it already has. Obviously, the currency is in complete freefall. Because the central bank have yet to raise interest rates and maybe will not be able to raise interest rates, it's quite possible that the Turkish lira will continue to remain very volatile, and that global markets around the world will also remain sensitive to shocks and to volatility because of the story that is developing with the Turkish lira. The Turkish economy and the Turkish market is seen as an emerging market, but generally what happens when there's such a period of very intense market volatility is that it causes a risk-off atmosphere from investors, when investors become less attracted towards investing in riskier assets, which generally include the emerging market stocks and the emerging market currencies. This risk-off atmosphere is exactly why other emerging markets such as South Africa, India, Indonesia, Russia, even the Mexican peso has been hit by this, have suffered in the early hours of Monday trade.
For more on this, let's bring in TRT World's editor-at-large, Craig Copetas from Paris. And in London, we have Neil Wilson, chief analyst at online forex and broker platform markets.com. Welcome to you both. Neil Wilson, if I can start with you first. Turkey's foreign debt burden has just got harder to pay, with the lira currently sitting at just under 7 to the US dollar. Could things get worse?
Well, yeah, I think they could get worse. I think we're all watching now for the possible monetary policy response from the central bank, and also perhaps some kind of more credible fiscal response from the government. I think really it's the central bank, though, that people are watching to see whether it's got that, it still has that independence, and it still is prepared to raise rates. I think we're looking at something in the region of a 300 to 400 basis point hike as being something likely to be enough to put a floor under the lira. But you know, we just don't know if they're ready to do that. Today's statement was a bit ambiguous, and I think you know, things could get a little bit worse from here. And I think we're all watching to see what the policy response is.
Yes, I'd like to talk more about the interest rate situation just a little later, but for now, Turkey's central bank has acted to stem some of the losses of the Turkish lira. As we heard in Mobin's story, it's begun to act by lowering the amount that lenders must park at the regulator, and it's also easing rules around how they manage their lira and foreign currency liquidity. Why isn't that enough?
I think you've seen that really the confidence has been lost in the Turkish economy. I think it's hard. It's very hard when you get behind the curve. I think, you know, the authorities in Turkey have maybe got a little bit behind the curve here, and are reacting, and it's just maybe not quite enough. I think the market's testing their response, and I think also, you know, there's no sign that the policy response will change. I think, you know, Erdogan in particular has made it clear that he's against raising rates, and there doesn't seem to be that you know, sort of sense that the Turkish side is going to budge under the sort of pressure. So something's going to break sooner or later, and it's either going to be the authorities in Turkey having to accept certain changes in policy that they maybe don't want to make, or you know, the lira is going to have to fall a bit further still.
Yes, let's look at President Erdogan's response. Craig Copetas, the president has accused the US of waging an economic war against the world, the aim of which is to make Turkey and other countries bend to its will on a number of issues. I'm wondering, does Erdogan have a point here? We are seeing evidence of these moves not only against Turkey but other countries as well, aren't we?
Well, the extraterritorial application of U.S. law as a tool of American foreign policy started under the Obama administration. The dollar was further weaponized during the first year of the Trump administration against Iran, Russia, Turkey, France, and, as you say, some other countries. But the weaponization was essentially conventional in that if you broke a sanction, you did a deal with a country the U.S. didn't like, you were hauled into a U.S. court, you had to pay a fine, someone may have gone to jail, and you had to do that if you wanted to continue doing business with the U.S. What the administration has done over the past few weeks is loaded these warheads with hyperinflationary fallout designed to take advantage and further distress Turkey's already precarious situation in the global marketplace. Look, they have an account deficit of somewhere between $250 and $230 billion. Whatever the amount, the working percentage here is that 70% of the Turkish economy is based on euro or dollar denominated debt. And the sanctions against Turkish officials and Turkish goods have not helped that. Trump has said and tweeted that this strategy against Turkey and other countries will result in what he calls world peace. Now, President Erdogan obviously disagrees with that, as do the leaders of many other countries.
Okay, Neil Wilson, let's talk about interest rates now. You mentioned them a little earlier. The benchmark rate in Turkey currently sits at 17.75%, which is high compared to, I guess, other economies of its size. But as you mentioned, President Erdogan is very loath to raise these interest rates. He says that they'll affect growth in Turkey, economic growth that is. I'm wondering, is there any other way around this?
Well, I mean, I think that really the authorities need to look at a mix of measures. You know, an interest rate hike is probably the normal course of action that we'd see here. But, you know, I think a credible response on the fiscal side, and potentially, you know, there's been talk around things like capital controls, I think that's maybe unlikely, but certainly they might eventually be looking at the IMF. I mean, it's a very, very serious situation, and I think that the initial response ought to come from the central bank here. And whilst, when you've got inflation running at around 20%, you do need to really act using those sort of more conventional policy instruments, which remain at their disposal. And whilst it would clearly hamper growth, I think as we've seen elsewhere in the past, the key thing is to get a lid on that inflation. Otherwise things can get out of control very rapidly, and that can destroy the economy, have a far greater impact on the economy than raising rates would do.
You mentioned in your first response some figures around what interest rate that I guess investors and traders might be satisfied with in order to stop this decline of the Turkish lira. Can you just explain that further to us? How do you come to that amount, to that figure?
Well, I think it needs to be firstly a signal of intent. If you just tweak the policy, we're not dealing with the Federal Reserve here that can simply, make policy tweaks and there's a major reaction in the markets. I think you have to, the central bank has to set its stall out and say that effectively it's going to defend the currency. It's not going to allow it to fall. And I think you need to push that rate up. I think sort of in the region of 300 to 400 basis points probably would do the trick, and just offer a strong enough signal of intent, as well as clearly the market pricing reaction that would follow as a result of that. But I think it's more about the central bank giving that clear signal of intent to the markets that is prepared to do what's required, and that is probably the key thing that we're looking at.
And Neil Wilson, before we let you go, we saw somewhat of a contagion effect spread to emerging markets as a result of the movements in the lira. Do you expect that to continue?
Yes, well, I think we've seen some contagion, but it is spreading into emerging markets a bit, obviously. But in terms of Europe, it seems isolated with the banks and those that are exposed, like BBVA in Spain and UniCredit. There's a few banks that have significant exposure to Turkey, but I don't think it's got any systemic risk for the European banking sector. I don't think that the exposure is high enough, but it could hit capital ratios and earnings going forward in the second half of the year for some of these banks, and I think more broadly we can see if there is a spread into a wider EM emerging market problem, then there will be other banks and other investment groups that will be affected by this. But at the moment, the contagion risk is fairly small, and it does seem to be contained at the moment. We don't know where the situation is going to go from here, and it could get a lot worse.
Okay, we will have to leave it there. Neil Wilson in London and Craig Copetas in Paris, thank you both.